September 1929. A New York businessman walks into his bank, presents his passbook, and withdraws every dollar he owns, $12,000 in cash. 2 days later, the markets collapse. Banks fail across the country. But he's safe. He has his money. Now imagine trying that in 2026. You sense danger. You log into your retirement account. $180,000 saved over 20 years. You click withdraw. A penalty calculator appears. Federal tax, state tax, 10% early withdrawal penalty. Your $180,000 becomes $98,000 before you see a cent. But here's what makes it worse. The withdrawal doesn't execute immediately. It enters a processing queue, 7 to 10 business days under normal conditions. During financial panic, when everyone's trying to exit, those systems can freeze entirely. This is the difference between 1929 and 2026 that nobody's discussing. Your wealth is trapped inside systems with time locks, penalty gates, and legal restrictions that slam shut when everyone tries to leave at once. Let me show you exactly how we got here, and why the traps are tighter than ever. In 1929, your money was actually yours. Walk into your bank, present your passbook, request your balance. The teller counted cash from the drawer. Same-day withdrawals were standard. No processing periods, no approval workflows, no suspicious activity reviews. If you wanted your money, it was yours within the hour. Stock ownership was equally direct. You received physical stock certificates, actual paper with your name on it. To sell, you could find a buyer directly and receive payment, or sell through a broker with settlement in 3 days, not 3 weeks. 3 days, predictably. This meant investors who sensed trouble in September 1929 had options. They could liquidate positions, withdraw from banks, convert everything to cash or gold. Many tried. The problem wasn't that the system prevented escape. The problem was most people didn't see it coming until too late. When the crash hit on October 24th, those positioned in cash survived. Those who hesitated were destroyed. But destruction came from their decisions, not from the system physically preventing action. Compare that to today. After 1929, regulators didn't just try to prevent another crash. They built something more ambitious, a financial system that could prevent people from escaping during a crash. The first cage was the 401k, created in 1978. $7 trillion in American retirement savings locked behind penalty walls. You contribute throughout your working life, but cannot access it without paying combined penalties and taxes that typically consume 35 to 45% of your withdrawal. But penalties are just the first lock. The second is time. When you request a 401k withdrawal, you don't get money instantly. Plan administrators process requests taking 7 to 10 business days under normal conditions. During market stress, when everyone's withdrawing simultaneously, timelines extend indefinitely. Some providers can legally suspend withdrawals entirely for administrative review. This happened during 2008. Fidelity suspended certain withdrawal requests for weeks. Participants logged in to find temporarily unavailable messages. Their money was there on screen, but they couldn't access it. Then there's banking itself. Try withdrawing $10,000 or more in cash. Federal law requires banks to file a currency transaction report. Banks also have discretion to delay withdrawals for suspicious activity review if they determine your request is unusual. Daily ATM limits typically cap at $500 to $1,000, meaning even with $50,000 in your checking account, physically accessing it would require 50 to 100 separate transactions over weeks or months. The crisis would be over before you could extract your own funds. The most insidious trap is in investment accounts, mutual funds, ETFs, brokerage holdings. Most investors don't realize their ability to sell depends on market makers maintaining liquidity, and that liquidity vanishes when you need it most. During March 2020, over 200 exchange-traded funds traded at 10 to 20% discounts to their underlying holdings. Your $100,000 ETF was only sellable for $80,000 to $90,000, not because assets had fallen that much, but because market structure broke down. Mutual funds have more explicit traps. SEC rules allow funds to maintain up to 15% holdings in illiquid assets. When those thresholds are breached, funds can suspend redemptions entirely. This isn't theoretical. The Woodford Equity Income Fund in the UK suspended redemptions in June 2019, trapping £3.7 billion for over 3 years. When redemptions resumed, investors received roughly 70 cents on the dollar. Every one of these restrictions was sold as protecting investors or maintaining market stability. But the effect is identical. Your money is no longer accessible on demand. It's accessible on the system's terms, according to conditions that can change during crisis. These traps have always existed, but 2026 is when they become catastrophic, not because mechanisms changed, but because of what's underneath: unprecedented debt, algorithmic trading, and a Federal Reserve that's already fired its bullets. In 1929, investors could buy stocks with 10% down, borrowing 90 on margin. That 10-to-1 leverage turned a 10% market decline into total wipeout. But today's leverage doesn't live in visible margin accounts. It lives in derivatives and private equity structures, creating 20 to 50-to-1 leverage hidden from view. When that unwinds, it won't happen over months like 1929. It'll happen in hours as computers execute pre-programmed selling strategies. Unlike 1929, when selling meant humans shouting orders on a trading floor, today 70% of volume comes from algorithms executing millions of trades per second. These algorithms sell when volatility exceeds thresholds. When one starts selling, it triggers others, creating cascades moving faster than humans can react. We saw a preview in March 2020. The S&P 500 dropped 34% in 23 days, the fastest bear market ever. Now imagine that with all the traps I described fully engaged. You watch your 401,000 drop 30% in 2 weeks. You submit a withdrawal request, willing to pay the 40% penalty. The request sits in processing while the market drops another 20%. By the time it's approved, you've lost 50%. Then pay 40% of what's left in penalties. Your 200,000 retirement account yields 60,000. That assumes the withdrawal gets approved. During peak crisis, administrators can invoke extraordinary circumstances clauses suspending all distributions. You're watching the number shrink, unable to act, trapped by systems designed for this purpose. The crash hasn't hit yet, but if you know where to look, the early moves are visible. In the fourth quarter of 2024, corporate executives sold stock in their own companies at levels not seen since 2021. Insider selling hit $16.2 billion in 3 months. These aren't retail investors panicking. These are CEOs and CFOs who see quarterly numbers before they're announced. When insiders sell, they're not timing a 10% correction. They're getting liquid before something bigger breaks. Remember that businessman in September 1929? He survived because he acted before the crowd realized danger was real. He didn't need permission. He didn't need to wait for processing periods or pay penalty fees. He saw the risk, took his money, and got to safety. You don't have that option anymore. The exits that saved him have been sealed, but you still have choices. You can acknowledge the traps and work within constraints. You can reduce exposure to penalty-locked accounts. You can build cash reserves outside the retirement system, accepting the tax burden now instead of risking total loss later. Or you can do what the majority will do. Trust the system, believe the reassurances, keep contributing to accounts you can't access in crisis, and assume this time really is different. Every generation thinks they've evolved beyond history's lessons. The 1920s generation thought industrial technology created permanent prosperity. The 2020s generation thinks artificial intelligence has conquered risk. They're all the same thought, wearing different clothes. The traps are set. The warning signs are flashing. Insiders are quietly heading for exits while telling you on television to stay invested. Your grandfather in 1929 could grab his money and run. You can't. Not anymore. But you can still prepare for what is coming if you act before the crowd realizes danger is real. Because once everyone tries to leave simultaneously, the gates close, the systems freeze, and the wealth you thought you had becomes a number on a screen that shrinks by the hour while you watch, helpless and unable to act.